I found the most undervalued companies in the market. We have 11 companies here, and in this video I will categorize them by undervalued, fair value, overvalued, and which I would sell. What's going on, investors? Hopefully guys are doing well out there. Without further ado, let's immediately start with Meta Platforms. Starting from the revenue of Meta Platform, you can see that revenue is increasing, most of the revenue coming from family of apps, as Meta is mostly the advertising company. And if you can see, there was a dip in 2022, and this was mostly to the Apple introducing their tracking policy and preventing Meta to get more data from other applications from Apple devices. But if you can see, in 2023 and 2024, Meta found a way how, by leveraging AI, still design very targeting ads, and the revenue continue to grow. Similar picture from the cash from operations, and now Meta is printing almost $100 billion in cash from operations. In terms of the business segments of Meta Platforms, as I mentioned, Meta is mostly the advertising company, with 162 billion is coming from family of apps and just 2 billion is coming from the reality labs. But Meta continues to burn money for the reality labs, which could be a moonshot in the future. Here you can see the profitability of Meta's business segments. From the perspective of family of apps, we are printing north of $87 billion for the advertising from Instagram, Facebook, and meanwhile Reality Labs is losing $17 billion per year. One of the things I was always bullish on Meta is because I believe that Meta is a global company and operating across the globe, and I was always bullish because I believe that Asia Pacific and also rest of the world, these two business segments, has a long way for Meta to grow and increase prices for the advertising. And also in these developing countries, the more people will be coming into the middle class, so finally they have higher salary and have more money to spend, so finally advertisers will pay more advertising dollars for these ads. Coming to the valuation of Meta Platforms, average median is 15, and right now Meta is exactly in the median. I believe that Meta is fairly valued here, but you can see here in 2023, when Zuckerberg was spending billions and billions on Reality Labs and Wall Street punished the stock all the way until forward price to operating cash flow 5. At these prices, Meta was dirt cheap. Right now I believe the Meta is fairly valued, so we are moving Meta into the fairly valued territory. The next company is Palantir. For the Palantir, the revenue is growing, and if you can see, the revenue from 2018 from 600 million comes to 2.8 billion. So in 6 years the revenue increased significantly. But my problem about Palantir is the price. If you can see, this is price to sales. This is not price to free cash flow, not price to earnings. This is price to sales. And for the Palantir, price to sales is north of 60. I understand that Palantir is probably one of the best positioned for the new AI revolution, and Palantir has a government business and also commercial business, and this commercial business, they are growing customers across the globe, not only in US. But my problem is that with the price of 60 price to sales, a lot of the upside is already built into the valuation. So I'm worried that the future returns could be relatively low just because of the stock is overpriced as for now. And I think bulls also would agree with this point that Palantir here is overpriced. You should definitely decide, do you want to sell your position or trim your position? But for me, I would say that Palantir at 60 times price to sales is a sell. And coming to the next company is Tesla Maesla. For the Tesla Maesla, we can see that the revenue is growing and growing significantly. From 2015 of 4 billion, we have 97 billion in 2024. This is absolutely significant growth. But the problem, if we pay attention to the revenue growth change, we can see that in the latest quarter, the revenue basically is not growing, is like less than 1%, and meanwhile all the news is coming that the Tesla is losing market share in Europe, and also Elon Musk is not paying so much attention to the execution and to the company of Tesla. Tesla's cash from operations also did not grow from 2022, and this is another concern. In terms of the delivery, we can also see that delivery did not really grow from 2023 to 2024, and in terms of the valuation, I would say Tesla is trading currently at price to operating cash flow at 58 price to operating cash flow. If we assume that, okay, the Tesla's business is different from, and if we just take the period from 2021 to 2024, then it kind of Tesla would I would say median is 44, but the question here is, do you really want to pay 44 times price to operating cash flow for the business which is not really growing? And the answer of the Tesla bulls would be, of course, that we are not really paying for the Tesla auto business. We are paying for the subscription business, for the autopilot, for the robotics and stuff like this. I would partially agree with this, but I believe that quite significant premium is already baked in Tesla stock, and Tesla is trading 10 times, 15 times more expensive than normal car companies. So I think all this is already priced in, and probably Tesla is overvalued here. I would not say that Tesla is a strong sell here, because I believe that Tesla is still one of the best bet we can do in the market on the robotics, because Tesla has a scale and Tesla can print their Optimus robots in many of the factories around the globe. So I think Tesla is quite good position for robotics, and I believe that robotics is the next $0 to $1 trillion industry. So I believe that it makes sense to have some exposure to Tesla, but to have significant exposure to Tesla probably does not make sense at these prices. Coming to the next company, Nvidia. For the Nvidia, the revenue is growing significantly, and if we can see after the release of ChatGPT, the revenue skyrocketed to 60 billion and then 130 billion, and the revenue continued to grow like 50% year over year. This is absolutely crazy. In terms of the segments, the main segment for the Nvidia, of course, the data centers, and we can see that the revenue of data centers absolutely skyrocketed to 115 billion in the latest reported year. In terms of the automotive revenue, I also would like to emphasize that Nvidia is working with different kind of car manufacturers to develop a self-driving software for them. And if we can see that there is already starting to show in the revenue, this is a subscription business. This is a high margin subscription business, even though the hardware business of Nvidia is also very high margin, but this is because just there is basically no competition and everybody else in the market is very far behind. But anyway, the software business is much more attractive than hardware business, as the software business is less cyclical. The next slide I would like to show you is Nvidia is buying significant amount of shares, so the management believes that the company is still undervalued here, and in the latest year we can see that management bought back more than $40 billion in shares back. In terms of the valuation, we can see that median price to free cash flow is 36.83, and right now Nvidia is trading at 30. So I would say Nvidia is, I think, closer to the fair value here, because it's really difficult to predict. There are already some signs. The chairman of Alibaba is saying about the bubble in data center spend, and also we can see that the hyperscalers are really buying all the GPUs like there is no tomorrow. There could be some kind of overspend and overestimation of the demand. Again, we need to remember that Nvidia is a cyclical company, so there will be some slowdown. So I would say that Nvidia, even though Nvidia is for the growth it is providing, is a relatively cheap company because it's still growing 50% year over year, but I would say that it's closer to the fair value than inside the undervalued category. And the next company in our list is Google. Let's immediately go to check the Google. For the Google, we have the mostly advertising company with the revenue increasing, and in the most recent year Google printed north of $150 billion in revenue. And the same about the cash from operations, 125 billion, absolutely money printing machine. Now the biggest worry of the Wall Street is that Google is losing market share, but so far we cannot really see this in the numbers. So if we can see here for the Google search, the revenue growth is accelerating. The search is still money making machine, and we do not really see the significant drop in the growth in this business. But from the cloud perspective, Google keep using operating leverage. For the Google Cloud revenue, it continued to increase, and also in the latest year we printed $43 billion in revenue and also $6 billion in operating income. This is significant. 2023 and 2024 are first 2 years where Google Cloud is profitable for Google, and the operating margin is increasing significantly, and this in the future will boost the operating margins for whole company, because the cloud is taking more and more market share inside the Alphabet's business. In terms of the repurchase of the stock, we can see that Google is just cannibalizing its own stock, and right now in the latest 3 years Google is buying back north of $60 billion in stock. In this case, if let's say we are facing some kind of market downturn on stuff like this, we can be 100% sure that the Google will be using its cash to buy back its own stock. So Google is relatively safe here. And in terms of the valuation, we can see that medium is 23 in terms of the price to earnings. And if we can see, this is the COVID. In the low of the COVID, Google was trading at 20 forward price to earnings, and right now Google is trading it at 18. So I believe that Google here is a very good deal, and I believe that Google here is a very undervalued company. So I put Google inside the undervalued category. I believe Google is a buy here, and all the risks they are already priced in. And let's immediately go to the next company, which is Microsoft. In terms of the Microsoft, it's very stable business model. If you can see from the revenue perspective, it's just keep increasing slow and steady. From the perspective of cloud revenue, the Microsoft is taking market share from AWS. The Microsoft Azure, Microsoft's cloud business is top 2 market share in the entire world, and in the latest year it printed north of $105 billion in revenue and a significant operating profit. In terms of the valuation for the hyperscalers, I'm using price to operating cash flow because they are significantly investing into the capex, which will affect price to free cash flow. So the price to operating cash flow for Microsoft, the medium is 20, and right now Microsoft is trading at a little bit north of 20. So I believe the Microsoft here is actually fairly valued. I put Microsoft into the fair value category. I think Microsoft could be a good buy here because this is the company where you can really sleep and not really worry about nothing because they have so many businesses. So for Microsoft, this is one of the best company in the world, and the only question is which price to pay. So of course would be very nice to pay less than 20 times earnings, but I think the position could be started here, not financial advice of course. Let's continue with the Apple. And for the Apple, we can see that the situation for Apple is different. Even though Apple is the biggest company in the world and I am the biggest fan of Apple, I have iPhone, I have iPad, I have Mac Mini, I have AirPods, I have many Apple devices. I enjoy using them, but I'm not investor in Apple. We can see that the revenue is not really growing. From 2022, the revenue is stagnating for Apple, and also for the free cash flow, we can see that from 2022, where Apple printed 111 billions in free cash flow, and in the latest 12 months, Apple is printing less than 100 billion, even though this is ridiculously huge amount of free cash flow. But still, to value the company, we always need to consider the price we are paying and also calculating the future growth. So for Apple, I'm not really sure the Apple can show the significant growth. In terms of the repurchase of the stock, that is basically why the Apple is not really dropping. Apple is repurchasing north of $100 billion per year of common stocks. And in terms of the valuation, I believe Apple is overvalued here. Apple is trading at 28 times forward free cash flow multiple. Meanwhile, the medium is 20. And if you make an argument that Apple at 2017 was not the same with Apple at 2025 because of services business, I would agree with you. If we move our timeline to 2020, we can see that the medium moved to 25 time earnings. I'm still not sure that this is the fair price to pay, 25 times forward free cash flow multiple for the company which is not really growing. If Apple accelerates the growth north of 5 to 10%, I think this would be totally different story. Very stable company, services business is a high margin and stuff like this. But for now, Apple did not really show us that it can grow. So I think that Apple is overvalued here. So I will move Apple into the overvalued territory and coming to the next company in the list, and this is Amazing Zone. Coming to the revenue here, the revenue of Amazing Zone increased from $207 billion in 2015 to $637 billion in 2024. Absolutely amazing growth. And from the perspective of AWS, the revenue is increasing, and now in 2024, AWS produced north of $107 billion in revenue and also significant operating profit north of $40 billion. Absolutely beautiful business. And And my main thesis about Amazon, disclosure, Amazon is my largest position with 26% of my portfolio. My biggest conviction and why I'm betting on Amazon is because I believe that robotics is the next $0 to $1 trillion industry. And I believe that with the such large revenue base, what Amazon can do is to increase the margins of its retail business. If we can see here, this is the operating cash flow divided by sales, which means operating cash flow margin. Amazon was significantly building capacity after the COVID, but now the operating cash flow margin increased to 18%. I'm betting that in 5 years, operating cash flow margin for Amazon will be north of 22 to 23. And if this is the case, the retail business will continue to print. If you can see here, the North America operating income is already north of $25 billion, and also the international is also printing north of $4 billion. I believe that robotics, the autonomous delivery, can increase margins significantly for retail business. And because the revenue is so large, every percentage of increase in the margin is a significant amount of improvement in profitability. So that's my main thesis about Amazon stock. And also Amazon right now is basically almost cheaper it was in decades. If you can see here, this was the COVID and Amazon was trading at 14.7, and right now Amazon is basically trading at the prices of COVID. So I believe that Amazon is significantly undervalued here, and I believe that Amazon has very large upside over the next 5 years. Next company in the list, and this is Adobe. For Adobe, I have more worries than for Amazon. The revenue is growing steadily. Most of the revenue of Adobe is subscription revenue, high margin revenue, but if we can see in the latest 3 years, the revenue slowed down to 10% year over year. And in terms of the valuation, Adobe is cheap. Adobe is trading at 19 times forward price to cash flow for the such high margin business, and for the recurring revenue. I believe this is cheap from one perspective, but my problem with Adobe is that their moat, I think, is under the question, and I cannot really fully answer the question, can Adobe actually protect their moat? Because right now, for example, previously I was making my thumbnails for YouTube videos in Adobe Photoshop, and I would need to pay the monthly subscription for that. But right now Canva is totally enough for me. I'm making my thumbnails in Canva, and that's why, even though historically we can see that Adobe now is dirt cheap, just because Adobe's moat is under the question, I would put Adobe into the fair value. And actually I'm not sure it's overvalued or fair value. I would say more closer to the fair value, because I believe that the recent price correction is already priced in some of the risks. This is at least what I think. If you think about if you think differently, please let me know in the comments below why I am wrong about Adobe stock. And we are coming to the next stock, and this is Visa. I believe that Visa is very strong company. We can see that the revenue is growing slowly and steadily, and the most important thing why I love Visa is because of their margins. We can see that gross margins north of 97.8%, and from the perspective of net profit margin, it's north of 55%. There are a few companies in the market who can make the profit margins more than 50%. Visa and MasterCard, two of these kind of companies, and that's why the regulators could catch this company to prevent them increasing the take rate indefinitely. But I believe that Visa is a solid company, and I was buying Visa under 25 times forward price to earnings here, and I sold when the Visa reaches 30 times forward price to earnings. Right now I do not have Visa in my investing portfolio, and I believe that Visa is slightly overvalued here, and we can see this from the historical perspective. So we would put Visa into the overvalued territory. And we are coming to the final company in the list, and this is Costco. From the perspective of Costco, the revenue is growing slowly and steadily, and the Costco is using the membership business model, where you basically need to pay for the membership to be able to shop into the to be able to do shopping in Costco. My problem with Costco is forward price to earnings of 50, and if we can see historically, I mean, in this period the average was somewhere near, let's say, 25, and then here the average is already 33, and now here we are here 50, I think this is ridiculous, even though for the business like Costco, people think that the Costco business model is very solid, and during the recession, people will still go to Costco. I partially agree with this, but the problem is that 50 times forward earnings is absolutely ridiculous for this company. So I believe that Costco is a sell here. Costco significantly overvalued, and you can see, yes, they are increasing the total card holders. This is the membership of Costco, but 50 times forward earnings is just not the price you pay for this company. So I believe the moat of this company is quite wide, but there is always a price to pay for the company. And there you have it. From the perspective of large and mega caps, I believe that Google and Amazon are the most undervalued stocks in the market. If you enjoy the content, please make sure to subscribe to this channel. Thank you so much for watching, and I will see you in the next one.